Can you afford Cary, North Carolina? Let's have a real talk about the reality of mortgage versus lifestyle. There is a massive difference between what the bank says you can afford and what you can actually afford while still living a life you enjoy. The bank might look at your income and say, "Congratulations, you're approved for a $4,000 monthly payment." But the bank doesn't care if you want to travel to Europe next summer. The bank doesn't care if you buy a latte every morning. And the bank certainly does not care if your HVAC blows up 3 months after moving in. If you buy a home in Cary based solely on that approval letter, you are setting yourself up to be house poor. So today we are going to do the real math, the lifestyle math, so that you don't end up resenting the beautiful home you worked so hard to buy. Listen, we've all seen the headlines about interest rates and home prices, right? But the biggest mistake I see buyers make isn't timing the market. It's misunderstanding their monthly payment. Many people look at a mortgage calculator online, see a number, and think, yeah, I can swing that. But that online number is usually lying to you. It's often missing the critical specific details like property taxes, insurance, and HOAs. And it definitely doesn't account for your student loans or your love for eating out. So today, I'm going to break down the total cost of home ownership in Cary. We're going to look at the anatomy of a payment, the hidden costs of maintenance, and how to reverse engineer your budget so you can keep your house and your lifestyle. So before I start, if you truly want to be the most educated buyer out there, feel free to download my free homebuyer guide located in the description below. Now let's move on. So what is the anatomy of a monthly payment? Let's start with the basics because this is where the confusion begins. When you pay rent, you pay one number. When you pay a mortgage, you're actually paying for 5 or 6 different things bundled together. We call this PITI, also known as principal, interest, taxes, and insurance. So first, you have principal and interest. This is the money going back to the bank. This number is fixed if you have a fixed rate mortgage. But then comes the variable stuff, property taxes. In Cary, you are generally paying taxes to both the town of Cary and Wake County. Right now, that combined rate is roughly 86 cents per $100 of assessed value. So if you buy a $600,000 home, you aren't just paying the mortgage, you're adding roughly $5,160 a year in taxes. That adds about $430 to your monthly bill immediately. And remember, taxes usually go up, not down. Next is homeowners insurance. This protects you against fires, storms, and liability, right? In our area, this can range wildly. So budgeting $100 to $150 a month, it's a safe starting point for an average home. Now, if you put down less than 20% for your mortgage, say hello to PMI, private mortgage insurance. This is insurance for the bank, not for you, in case you default. Depending on your credit score, this can tack on another $50 to $200 a month. It's money that literally disappears into thin air. So that $2,500 mortgage payment you saw on Zillow, once you add taxes, insurance, and PMI, it might actually be $3,300. That is an $800 difference. That is a car payment. And wait, there is more. If you are looking in Cary, you are almost certainly looking at a neighborhood with an HOA, the Homeowners Association. Cary is famous for its planned unit developments. These keep our property values high and our neighborhoods looking pristine, but that comes at a cost that is not included in your mortgage payment to the bank. In Cary, HOA fees, they vary drastically. You might find an older neighborhood with a voluntary HOA or mandatory with a low fee of $50 a year. But if you are looking at a townhome where they cover the exterior maintenance, or a luxury community with a pool, clubhouse, tennis courts, you could be looking at $100 or $200 or more per month. So I have seen buyers qualify for a home, get excited, and then realize the $100 monthly HOA fee pushes their debt to income ratio into the denied zone, or worse, the approved but miserable zone. You have to treat the HOA fee just like any other debt. It is a mandatory monthly obligation. If you skip it, they can put a lien on your home. So now that we know the structural costs, let's talk about the lifestyle costs. This is the part the bank ignores completely. The bank calculates your debt to income ratio using your gross income, money before taxes, and your minimum debt payments. They do not look at your grocery bill, your daycare costs, your travel fund, or your daily Starbucks habit. If you want to ask yourself a hard question, do this. Are you willing to sacrifice your lifestyle for zip code? Because let's talk about that latte factor. It sounds cliche, but if you spend $200 a month on coffee and snacks and another $400 on dining out, that's $600 of lifestyle money. Now, that is, if your new mortgage payment like eats up all of your disposable income, that $600 is gone. So you are now drinking instant coffee and eating ramen in your beautiful new granite kitchen. And what about student loans? Even if you are on an income-driven payment plan with a low payment right now, you need to budget for what that payment could be in the future. Do you want to travel? If you take that max approval from the bank, you might have a stunning guest room, but you'll never have the money to buy a plane ticket to leave it. Being house poor means you have a great house, but you feel trapped inside it because you can't afford to do anything else. I don't want that for you. I want you to have enough margin to breathe. There is one more cost that catches almost every first-time buyer off guard. When you rent and the toilet breaks, you call the landlord. When you own, you are the landlord. You need to budget for the unsexy stuff. I'm talking about water heaters, roof repairs, and HVAC units. In Cary, our hot summers put a beating on air conditioners. Replacing a unit can easily cost $8,000 to $10,000 plus. A good rule of thumb is to budget 1% of your home's value annually for maintenance. If you buy a $600,000 home, you should expect to spend or save roughly $6,000 a year on upkeep. That is $500 a month. Okay, so some months you won't need to spend a dime, but then one month your refrigerator will die and you'll need a tree removed all at the same time. If you don't have that $500 a month built into your budget, those repairs go on a credit card at 20% interest, and suddenly your affordable home is a financial burden. So don't look at maintenance as an if, look at it as a when. So, how do we fix this? How do we find the right number? I want you to work backwards. Don't start with the bank's number, start with your number. Take your monthly take-home pay, okay? Subtract your absolute needs, food, utilities, cars, student loans. Subtract your joy budget, travel, hobbies, dining out. Subtract your savings goal, retirement, emergency fund, whatever is left. That is your maximum housing payment, including taxes, insurance, HOA, and that 1% maintenance fund. This is your sleep at night number. It might be lower than what the bank approves you for. And that is okay. It is better you buy a slightly smaller home or a home in a different neighborhood and sleep soundly than to buy a mansion and stare at the ceiling worrying about money. You already know that I believe buying a home in Cary is fantastic. It is a fantastic investment, but only if it fits your life, not just your loan application. If you're ready to run the real numbers and find a home that fits your budget and your lifestyle, reach out to me. My contact information is below. Be sure to grab my NC Buyer cheat sheet to truly be the most educated buyer out there. It's also in the description below. And if this video saved you from making a huge financial mistake, hit that like button and subscribe for more honest real estate video advice. I'm Nina Gervasi, helping buyers make smarter moves in Cary. Thanks so much for watching, and I look forward to seeing you in the next video.